Hello, this is Brian Shannon from AlphaTrends.net. Today is Monday, July 21st, 2008, and the market's just closed. The S&P 500 finished with a gain of 10 cents, and you can see here it's still struggling with this declining 20-day moving average. And the real big thing that you're going to notice here, or at least that I noticed, that kind of jumps out at me, is the real dry up in volume in here. The market is still kind of struggling in this area. Obviously, we remain in a downtrend, and this bounce that we've seen off last week's lows, very impressive, from about 120 to 126, but it seems as though buyers are losing confidence, and now it's the buyer's game to lose again. So we're going to be very cautious in here. Looking at a 10-minute time frame, this 126 area has been an important level for the market. It continues to be, and what we're starting to see is these moving averages are crossing back and forth a lot. Those crossing moving averages represent indecision in here, and it looked, we had a little bit of strength early on the open. That failed, and then it was just kind of choppy trading with a slight downward bias to it throughout the day. When we look at the 1-minute time frame, you can see it pretty much remained below the daily VWAP all day. But again, the very light volume indicates the sellers weren't really strong, more of a lack of buyers' conviction. The first level of importance on the downside, as far as where we may find support if this market does pull back a little bit deeper, is going to be 125, and then below that, just below the 124 level, about 123.80 or so. Those are going to be important levels for this market to hold. I still think that it would be healthy for a pullback down towards that 124 level. When we back up a little bit and look at this hourly time frame, you can see here this is the steep downtrend line that we had broken, and here we are at that 126 level. And let's just make that a little bit clearer to see by looking at a 30-minute time frame instead. Each one of these candles now representing 30 minutes instead of the 60 minutes we had just been looking at it. And the key thing here obviously is we're in the middle of earnings season. This week has the largest amount of companies reporting, a lot of big influential companies, so that's really going to dictate things. Be sure that if you're holding stocks overnight, you know whether or not they're due to report earnings, because you don't want to wake up and get blindsided like some investors in Google have. And Google continues along its path of least resistance here recently. A lot of people, I bet, are probably getting hurt badly, thinking it was an overreaction. But the fact is, Google's in a downtrend. We've got a 10, 20, 50, even 200-day moving average, which are all declining. So Google still looks like it's in trouble. I would suggest you stay away from that one unless you're just a very aggressive trader. Back to the S&P 500, though, on this 30-minute time frame, we're in a pretty critical area here. Encouragingly, we have a rising 5-day moving average, but the daily time frame still takes precedence as we continue to do battle with the important level from earlier this year, and that is the January lows and the March lows that we had seen some washout sell-offs occur on big news, and that's what we had in here again. So it's at a critical juncture. It can go either way. I don't have any firm convictions in this market, so I think you just got to focus on the shorter term trends and focus on finding the right stocks at the right time. It's one of those times where when the market, when in doubt, probably ought to just stay out. Oil we were looking at, and it suggested that, this chart here with the breakdown from the trend line, but with a rising 50-day moving average, that maybe we're due for a little bit of a bounce here, similar to what we had seen in gold earlier in the year, where gold broke down hard, spent 2 days below that 50-day moving average, rallied up towards that 10-day moving average. We'll look at gold again in a moment, but that could suggest a rally up towards 110 or maybe 109. As the 10-day moving average is obviously a moving average. It's going to decline. It's going to be dragged lower over the next couple days. Even if oil rallies $1 tomorrow, it's still going to decline because we're replacing data from 10 periods ago. The point is, though, I would be looking at this as here's an opportunity maybe for oil to be putting in a potential trade to the downside, and again, I would look at that DTO. But right now, on the 30-minute time frame, we had seen that this level had been prior support just at about really 106 and a half to 107. I think that's going to be the important level. level. So getting back above 107, maybe we get a little bit further bounce towards that 110 or so. But oil appears as though it may be in trouble here. I don't want to call it a top yet, but if we see a lower high develop and then a lower low, that's going to be very encouraging for lower oil prices. Gold, I had suggested we take a look at, continue to look at this week because it had broken past some resistance. That resistance looked like it was acting as support near the rising 10-day moving average. Then when we looked at the 30-minute time frame, we had seen this nice uptrend line here that the market was hanging on, and this prior level of support, prior level of resistance rather, had the potential to act as support. I thought the 10-minute chart looked like maybe it could have been breaking down a little bit further, but buyers came in here today. Now it's battling with that 5-day moving average. We're getting very close here towards this market, the buyers getting back in control, and I think tomorrow could be a good day for gold. So keep an eye on that, and if you are trading it to the long side, I think breaking back below probably this 93, 95, let's say, on the GLD, breaking back below there, then I would move to the sidelines. But some of the gold stocks look like they're setting up, and that RGLD, I'd mentioned that a couple weeks ago right in here. Another big day here from this real nice pennant pullback, and there's a lot of similarly situated gold stocks to take a look at that look as though they can continue higher. The Russell 2000 was up 74 cents today. This market, it continues to be the relative strength leader. It holds on best to the gains that it's seen recently. The bigger level in here for this market will continue to be $68 a share. That's a key level as far as what should be support here the next few days. Same thing though as far as volume goes, trailing off the last few sessions, but really breaking back below 68, and that's where we have a rising 5-day moving average as well. Breaking back below there, I think you want to get a little bit more cautious because we still do have a big mess here on the daily and on the weekly time frame. It held up above the year lows in this market, so on a relative strength basis, it didn't make the lower low, and it's also recovered quicker and with a better percentage gain. But we do have that volume trail off, so perhaps we see a pullback down towards 68. If it behaves well and can continue to rally from there, then maybe there's a good long entry point. But very tricky market with the mixed signals from all these different time frames. The primary trend, though, as represented by the declining 40-week or 200-day moving average, still remains lower. So we're officially in a bear market. Any rally in here still has to be treated with suspicion. It doesn't mean it can't be the basis of a turnaround, but the evidence just isn't there yet. In the weaker group here, I think, continues to be the NASDAQ 100. That's found some resistance last Thursday at the declining 20-day moving average, and it's unable to really get anything done in here. Today it was up 10 cents or 19 cents rather, but on Friday it had that really bad close. So basically I look at this market as pretty much unchanged for the day. Right at the end we had that that one print, but it was the official close, so it's chalks up in the positive column, up 19 cents. Looking at let's take a look at the 30-minute. Let's take a look at the hourly time frame. Hourly time frame, we'd seen what we see here is we've got this high on June 5th. We've got this high here at about June 19th, and then last week's high that was coincident with the declining 20-day moving average here on the daily time frame. So going back to the hourly time frame, we still see this downtrend still intact. Now what I was outlining was the possibility of a setup where 46 is obviously a level of resistance. That's been established here numerous times. It takes on added significance because that's where the trend line was hit most recently as well. Now, if this market can find the ability to somehow reverse in here, it's looking like on the hourly time frame that the potential for we're being near the bottom of the right hand shoulder in here. Now, again, this is a reversals. You can find a million reasons to look for a reversal in a downtrend, and most of them will tend to fail because a trend is more likely to continue than it is to reverse, but you have to have your eyes open to the potential for a reversal. So look at this as a high risk potential trade. If this market, though, can get back above this 45.23, and that's the level I had set on Friday, and that was about today's high as well. So if it can get back above 45.23 and hold above there, especially for a couple hours or so, then we've got the potential that this market has in fact put in that right shoulder on the hourly and 30-minute time frame like we're looking at here. But what would invalidate it is breaking back below 44.50. So if you're looking to play the long side, right now it looks as though the buyers will retake control of the short-term trend at about 45.23, and then the intermediate term trend at above 46. What would invalidate that would be a move back below 44.50. So if you decide to take a long trade, be aware that you have to have your stop in place. Don't be stubborn and stick to a belief that you think the market is down too much or whatever. Again, we've got a lot of big influential companies reporting earnings, so it's going to be continue to be treacherous.